Welcome to the What It Means podcast. I'm Jonathan Miller. We're sitting here in the dog days of summer, August 12th, 2025. For those of you that don't know me, I am the co-founder, presidency of Miller Samuel Real Estate Appraisers, which began in 1986. I'm the author of the Douglas Elliman Market Report series that I began in 1994. And I teach a master's in real estate development course at Columbia every summer. I've been doing that since 2017. And I'm the author of Housing Notes. You can read at housingnotes.com. I've got lots of usually 3, sometimes 4 posts a week on topics of the day that are going around. I'm going to cover or touch on some of that today. But the actual name of this episode is called My Implicit Guarantee. And I'm going to talk about that and mortgage rates, sort of at a high level, not getting too much into the weeds, so that you have a better understanding about some recent news about the mortgage market. The first thing I thought I'd do is let's go right into the Fannie Mae and Freddie Mac, who basically guarantee or purchase about 50%, a little over 50% of the mortgages in America. And the reason why that's important is because they are government backed, meaning that they're in conservatorship. They ran into trouble, one of many incidences, I can't speak, over the years, or they've gotten into trouble, and in this case, during the housing bubble, they were taken over in 2008, and they have essentially paid back the billions that it took to bail them out. And now the new FHFA director, that's the regulatory agency that oversees them, Bill Pulte, who is the grandson of the founder of Pulte Homes, um, had announced that they had planned to bring them public. And why should you care? Uh, uh, well, first of all, then it was taken back that probably aren't going to do anything. And then over the weekend, it was announced that they were going to try to do it in November. And couple things that are happening. When they're talking about basically creating, it's called the Great American Mortgage Corporation. And I wrote about this in Housing Notes. And the idea is they're essentially merge Fannie Mae and Freddie Mac. Um, to know the difference, Fannie Mae was created during the Depression to basically stabilize and strengthen the mortgage market. Whenever I describe the housing market, I say housing is local, but mortgages are national. And Fannie Mae is one of the reasons why we're able to have a 30-year fixed mortgage. I don't know how many of my listeners are aware, but we're the exception in the world. Most countries, mortgage rates are variable rates, adjustable rates. They ebb and flow with interest rates. In the US, that is not the case. The majority of lending is done on a 30-year basis, which keeps payments consistent, as opposed to fluctuating. Um, the um, the reason why I bring up there are these two agencies, and one started during the Depression, and then Freddie Mac was brought in the 70s to be a competitor of Fannie Mae to create competition, probably shave costs, help the consumer, but really they're just like a stepchild or distant cousin of Fannie Mae. They basically copy everything Fannie Mae does. And so this mortgage consolidation company, they're called government sponsored enterprises, they would merge into one. Here's the problem with this. First of all, as I've talked about in prior podcasts, we are still in what I would call peak uncertainty. Our uncertainty has uncertainty, and we've been talking about this for ages. And that's the big reason why um, housing sales are below long-term norms. That we've had 2 years of an underwhelming spring market. Mortgage rates have been sort of stuck at an elevated level, and if there is a IPO, essentially uh, taking these two GSEs, government-sponsored enterprises, and putting them into the public, there's a question of whether they'll still be sort of government backed or have a federal backstop, meaning that if they fail, um, then the government bails them out as opposed to letting them die. And the reason why that's important is because without that, it's called an implicit guarantee. That's my sort of phrase of the month, implicit guarantee. Um, the implicit guarantee means that Fannie and Freddie, the mortgage rates that you get um, because of the implicit guarantee are about 0.5% to 1% below what the market pays. In other words, the backing of the federal government makes these loans issued or guaranteed less expensive than mortgages that are the other 50% of the loans in the United States. And the reason why, that's a problem is because the elevated interest rates, not that interest rates are historically elevated, but relative to the pandemic era, they're up quite a bit. Um, uh, the idea here is that the way you're going to stimulate housing is by bringing down rates even a little bit. And last week we were starting to see rates drift a little faster downward because became a clear understanding that the U.S. economy was definitely weaker than everybody was thinking, and that the impact of tariffs on jobs was actually quite severe. Sort of the way to think of it is, you've been probably reading about how difficult it is for a college graduate to get a job, even though mortgage rates are, I mean, unemployment rate is, in the, relatively low historically. So it's sort of confusing. But the reason I bring this up is I don't understand why we're doing this you know, it's going to raise uh, 30, $40 billion for the US Treasury, but it also is creating more uncertainty. And uncertainty is the enemy in the context of the housing market and people having confidence to buy. Um, it's just a problem. So, what happens if Fannie Mae and Freddie Mac become the Great American Mortgage Corporation? Well, the first thing that happens is mortgage rates tick up a little bit, 0.5%. That's the range I'm hearing. Um, Also, lending standards, banks are now there's more uncertainty. So banks will be more difficult in terms of, underwriting will be more challenging for buyers in the context of getting a mortgage. Um, uh, Fannie Mae and Freddie Mac save about $2 billion a year in financing, raising money because they have this implicit guarantee that that they had the backing of the federal government, and that goes away. Um, so it's kind of a weird situation. The other thing is, just as an aside, for a loan to be, there's other reasons, but for a loan to be considered a conforming rate mortgage, in the US, the typical threshold is $806,500, meaning that if your mortgage is that amount or less, you can qualify for a Fannie or Freddie mortgage and get the lower rate. In high priced housing markets like New York City, the number is 1,209,750. And so basically 1.2 million and below, you can get a single family or condo or co-op in New York City loan and most of the outlying region around the US. Um, uh, why, just I had a thought. Sorry, it popped in my head. When I first started Miller Samuel and appraising in New York, the conforming loan rate was 407,000, which was in the mid 80s. Now it's a million two. It's it's uh, it's tripled. And one thing I've learned over the years about conforming loan rates to qualify for Fannie or Freddie, because think of them as a locomotive and to fulfill the American dream and home ownership for more, you've got to keep putting coal in the engine to keep the locomotive moving forward. And one of the ways you do that is you keep expanding the conforming loan limit. So it went from 417 to now over a million two in our market, which is basically triple, and prices in that period have not tripled. So it's kind of interesting. Um, anyway, I bring this up because it's just part of this. When we think about all the uncertainty with tariffs, with with now this IPO for the GSEs, Fannie and Freddie, the potential loss or reduction of the implicit guarantee, which makes mortgage rates higher. Um, it doesn't help. It's not good for the national housing market. It's actually unfortunate. Um, anyway, enough of that. Just know that I would keep your eyes open for it. It will be a rising issue. The probability is it won't happen in November because to do the biggest IPO in the history of the world, I think it would be like $500 billion. You can't get that done in 3 months. So my wild guess is that if this were to happen, I don't think it will, but if it does happen, it'll be later in 2026 before it actually happens. But honestly, who knows? Um, Now let me move on to another topic, which I think is a little lighter. One is it's a post I wrote on Housing Notes. I encourage you to listen to or read. It's called "Don't Fence Me In," and it was triggered by I read an article about Ken Griffin, the billionaire who has been amassing waterfront property in Palm Beach, Florida for seems like a decade. And I want to say, I'm just off the top of my head, he spent over a $500 million assembling property. And one thing he's just applied for is the permission to build a taller than legal fence around his property. And listen, if I were worth billions of dollars, I'd probably want a privacy fence as well around some of my assets just for privacy. That seems understandable. Um, but it got me thinking about fences in general, and we don't think about or we don't talk about them enough, I think. I was thinking in Manhattan, uh, Miller Samuel, my appraisal firm, we appraise a lot of townhouses. And, a typical townhouse in Manhattan is on a 20 by 100-foot lot, and the building is usually 4 stories and is 20 by 50. So 4,000 square feet, 4 times 1,000 per floor, and then you've got a 20 by 50 backyard. In my 40 years of appraising and my firm, I've never, except for one time, been in a backyard of a townhouse that didn't have a fence. And and then there was a townhouse that I had been in a long time ago. There are three townhouses in Carnegie Hill in um, sort of the upper end of the Upper East Side of Manhattan. That three townhouses had a common. They shared a backyard, and I want to say I can't remember how that happened, but it's just so unusual. And then I was looking into, so you rarely, at least in the thousands of townhouses my firm has appraised, you just don't see townhouses without fences in the backyard. So it's not a value add, it's sort of like a value, it's sort of a have to, that they always come with fences or your neighbor has a fence kind of thing. I bring that up because in the suburbs, um, I've I did a lot of reading about it as an amenity and looked at what appraisers have been writing about it, et cetera. And what I found is that people that put in fences, the in fact Redfin had a study on this. I don't know if this is sort of junk stats or real numbers, but um, they extracted that the cost or the market value add of a fence, um, you basically only get, call it 50 cents on the dollar, meaning that um, for what you spend on a fence, you only get about a half of that back in terms of contributory value to the property. Redfin's range is like 30 to 70%, which is kind of like saying 1% to 99%. I mean, it's such a broad range, but I'm sure it varies in different, depending on what's the norm for the neighborhood. But fences are something that are there, and many people don't think about it. I don't think I've ever, trying to think, I've never owned a house with a fence around the backyard, but I do have a pool, and that does have a fence, but that's required by law. That's not something that I've had. One of my sons had a fence surrounding his backyard, a prior house, and it fell over, like almost hit his young baby boy. So they're not to be ignored, but I just feel like they don't get enough attention. Anyway, that's probably enough fence talk for a millennium. And the last thing I want to talk about is a little bit about the land and touching on what's going on in Pacific Palisades in LA. Um, I, um, I wrote about this because with social media and blogging, we'll get, when there's a tragedy or an event, we'll get, a bunch of real estate agents or, just people in real estate that maybe start tracking a stat and we were seeing this in LA where I believe 47 out of 6,600 residential structures out of 6,600 structures that were destroyed in Pacific Palisades. So there's a lot of empty lots, and the city of Los Angeles reports for the city that they've cleared about 85% of the debris, which is encouraging. But what was interesting is I kept reading about, there's a zillion, land sales or lot sales. And I'm trying to think to myself, it's way higher than it was, but it's still like the land isn't, going for what land went for before. And I'm thinking to myself, like, how are you doing that? I give you an example in Pacific Palisades, year to date through mid-July, there were, I'm looking it up here, there were something like 72 lot sales. And a year ago, pre-fire, there was one. And so you say, wow, the market is really like lot sales, are up, an astronomical percentage when it's not apples and apples. It's a totally different environment. Another stat I've seen thrown around is home sales in Pacific Palisades, and I track Pacific Palisades as a neighborhood in our Los Angeles market study for Douglas Elliman. And Pacific Palisades, with a median price in the mid 3 million range, home sales are down 66%, so two-thirds. Well, why are they down two-thirds? Is it because people don't want to live there? Or is it because the majority or a vast number of homes were burned down, right? And there's a lot of uncertainty in the market. So, excuse me, the idea that sort of these early stats are being presented in a way that it's not that the data is wrong, but I think it needs an asterisk, or it needs an explainer um, as to why the numbers seem so extreme. I give you an example. Homes that are sold or worth 10 million or higher in Pacific Palisades, 79 of them were burnt to the ground. Um, so there's less property to sell in sort of the organic mix, the ebb and flow of the sales market. And I just wanted to point that out because I don't like to read stories about the housing market without proper context. Um, Frankly, I'm really encouraged that there's been um, so many land sales in this neighborhood and in many other neighborhoods as well. Altadena is seeing even bigger volume of transactions. And one thing we're seeing, at least so far, is that, other than a few speculators, you're not seeing people come in and buy, lots of lots. These tend to be single lot purchasers, which is encouraging in terms of like rebuilding the neighborhood, rebuilding the city, getting the city back to, on its feet. I know there's been a lot of attempts by the city to accelerate the home building process, the permitting process. Otherwise, between the shortage of labor, both with immigration policy coming out of Washington, and the shorter, the construction industry has been um, crushed by labor shortages. So that makes labor a lot more expensive. And also materials with the tariffs. Um, Tariffs in or out, our sort of trade war with our ally Canada is raising the cost of everything. So the bigger point on this, and this is something I first saw with Superstorm Sandy back in 2012 in the Northeast in New York City Metro, is that properties that are damaged during a natural disaster uh, quite often are replaced with higher end properties or larger properties, or combining lots to create larger properties. Um, and so as a result, there's a lot less middle class housing in New York City Metro on the water than there was, before Superstorm Sandy in 2012, because two adjacent lots were combined and then a larger house was built on it. Why? Because as you move higher in wealth, income, you have access to cheaper alternative financing, and you are less, or you're less impacted by higher FEMA rates and insurance, wildfire, etc. You maybe have a higher probability of paying cash, so you don't even need insurance. Um, Although that seems crazy to me, but when you have a mortgage, you need to basically assure the lender that you're covered for natural disasters so that the house that they're using as collateral against your loan is protected. And so what you tend to see is in these markets, the replacement of the adversely impacted properties tends to be a higher quality, a larger property. Not always, but it tends to be. And this just adds to the national challenge of home affordability, where the housing stock that we're rebuilding or building tends to skew higher end because that's how the economics are sort of um, working at this particular moment. Anyway, hope that was helpful. I appreciate uh, you taking your valuable time to spend it with me. I hope you got something out of this. And until next time, just remember that pie is better than cake.